Have you ever wondered how to generate passive income through real estate investment trusts or REITs? That's what we're here to delve into today. REITs, short for real estate investment trusts, are companies that own, operate, or finance income-generating real estate. Ranging from office buildings and apartments to hospitals and shopping centers, the diversity of property types is vast. Now here's where it gets interesting for you as an investor. REITs are traded on major stock exchanges just like any other stock. This means you can buy and sell shares of a REIT, gaining exposure to real estate without the need to own property directly. The real cherry on top? REITs are required by law to distribute at least 90% of their taxable income to shareholders annually, primarily as dividends. This is where your potential for passive income comes into play. Stay tuned to discover the step-by-step process to invest in REITs. Now you might be asking, why invest in REITs? Well, let me tell you, there are several distinct benefits that make REITs an attractive investment option. Firstly, they offer diversification. With REITs, you're not just investing in a single property, but a portfolio of properties. This reduces your risk as your investment is spread across different properties and geographical locations. Secondly, REITs provide regular income. They're required by law to distribute at least 90% of their taxable income to shareholders annually. This means you can expect a steady flow of dividends, making them a great source of passive income. Lastly, there's the potential for high returns. Real estate has historically been a solid investment, often outperforming other investment types over the long term. With REITs, you can share in this wealth generation without the need for large capital outlays or the hassle of managing properties. Sounds good, right? Now let's dive into how you can start investing in REITs. Before you start investing, it's important to understand the different types of REITs. Each type of REIT offers unique characteristics that can align with your individual investment goals. So let's delve into the three main types: equity, mortgage, and hybrid REITs. Firstly, we have equity REITs. These are the most common type of REIT. Equity REITs own and operate income-producing real estate properties. The revenue generated from these properties, whether they're shopping malls, office buildings, or apartment complexes, comes primarily from rent. Investing in equity REITs allows you to profit from the income these properties generate without having to buy or manage the properties yourself. Then, we have mortgage REITs, or MREITs. Unlike equity REITs, mortgage REITs don't own real estate properties. Instead, they finance real estate, which means they invest in property mortgages or mortgage-backed securities. The income from mortgage REITs comes from the interest earned on these investments. If you're interested in the financing side of real estate and want to capitalize on interest income, mortgage REITs could be a good fit. Last but not least, we have hybrid REITs. As the name suggests, hybrid REITs combine the investment strategies of both equity and mortgage REITs. They own properties and invest in mortgages, offering a balanced blend of investment opportunities. By investing in hybrid REITs, you can benefit from both the property income and the interest income. Each type of REIT has its unique pros and cons, and the right one for you largely depends on your investment goals, risk tolerance, and market outlook. Equity REITs can provide steady income from rents, mortgage REITs can offer higher yields due to interest income, and hybrid REITs give you a mix of both worlds. Understanding these types of REITs can help you make an informed decision about which one aligns best with your investment strategy. Once you've decided on the type of REIT that fits your investment goals, it's time to choose a specific REIT to invest in. So, stay tuned as we move on to the next step in our journey of investing in REITs. Choosing a REIT to invest in can be a daunting task, but don't worry, we've got you covered. First and foremost, investigate the quality of the management team. This is a crucial factor since the team's decisions will significantly impact the performance of the REIT. Look for a team with a proven track record in real estate investment and management. It's worth noting that a good management team will have a clear, comprehensive strategy for growth and risk management. Secondly, consider the REIT's dividend yield. This is the return on your investment, expressed as a percentage of the share price. It's important to remember that a high dividend yield is not always a good thing. It might be a sign of a struggling REIT trying to attract investors with high returns. Instead, look for a REIT with a stable and sustainable dividend yield. Another factor to consider is the REIT's property portfolio. You'll want to understand what type of properties the REIT invests in and where these properties are located. A diverse property portfolio can help to mitigate risk. For example, if the REIT invests in both residential and commercial properties across multiple geographic regions, it's less likely to be impacted by a downturn in any one sector or region. You should also pay attention to the REIT's financial health. Look at key financial indicators such as the debt-to-equity ratio, which can provide insight into the REIT's financial stability. A high debt-to-equity ratio may indicate that the REIT is heavily reliant on debt to finance its operations, which could be a red flag. Lastly, don't forget to consider the REIT's market valuation. This can give you a sense of whether the REIT is overvalued or undervalued. While it can be tempting to invest in a REIT with a low market valuation, it's important to understand why the market has valued it that way. Once you've chosen a REIT to invest in, it's time to make your move. Scene script. Ready to make your first REIT investment? Here's how. Step 1. Opening a brokerage account. This is your ticket to the world of investing. Choose a brokerage that offers access to a wide range of REITs. Look for low fees, robust customer service, and intuitive trading platforms. Remember, this is the vehicle that will carry your investments, so choose wisely. Next, step 2 is doing your homework. Before you dive in, understand the specific REIT you're interested in. What type of properties do they own? How have they performed in the past? What's their strategy for growth? These are just a few of the questions you need to answer. You wouldn't buy a house without inspecting it first, would you? Treat your REIT investment the same way. Step 3. Diversification. Don't put all your eggs in one basket. Diversification is the key to managing risk. Consider investing in several different REITs that focus on different types of properties and locations. That way, if one sector of the real estate market takes a hit, your entire portfolio won't suffer. Step 4. Decide how much you want to invest. As with any investment, only invest what you can afford to lose. A common rule of thumb is to allocate no more than 20% of your portfolio to REITs, but of course everyone's situation is different, so do what makes sense for you. Finally, step 5, purchasing the REIT units. Once you've done your homework, decided on your allocation, and chosen your REITs, it's time to make the purchase. Simply log into your brokerage account, enter the ticker symbol for the REIT you want to buy, and execute the trade. Don't forget, investing is not a one-time event. It's a continuous process of monitoring, evaluating, and adjusting. Keep an eye on your investments, stay informed about the market, and be ready to make changes as needed. And there you have it, you've just made your first REIT investment. Before we wrap up, here are some tips and warnings to keep in mind when investing in REITs. First off, don't put all your eggs in one basket. Diversification is key in any investment strategy, and REITs are no exception. Spread your investment across different types of REITs and sectors to mitigate risk. Secondly, beware of chasing yield. High dividend yields can be enticing, but they can also be a sign of trouble. Always do your homework and understand the fundamentals of the REIT before investing. Thirdly, consider the management quality. A good management team can make a significant difference in a REIT's performance. Look at their track record, their strategy, and their alignment with shareholders' interests. Lastly, don't forget about taxes. REIT dividends are typically taxed as ordinary income, which can be higher than the capital gains rate. Remember, investing in REITs should be part of a diversified investment portfolio. That's all for today's guide on how to invest in real estate investment trusts for passive income. We've journeyed through the ins and outs of REITs, exploring their benefits, and understanding the different types that exist. We've delved into how to choose the right REIT to invest in and walked step by step through the process of investing. We also shared some valuable tips and warnings to keep in mind as you embark on this exciting investment journey. Remember, knowledge is power. The more you understand about REITs, the better your decisions will be. Don't hesitate to revisit this video if you need to refresh your memory or gain deeper insights. We're here to help you make your financial dreams a reality, one video at a time. If you found this video helpful, don't forget to like, subscribe, and share it with others who might benefit. See you in the next video. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only, and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.